If you can lock up your portfolio, throw the key away, you'll probably do okay. The problem is if you hit these super bubbles that concern me, these 3 sigma outliers, in 1929, you didn't get back until 1956. And in 2000, you had lost a lot of money by 2009, and you got back in the game about 2012. And the same with the housing bubble. You can have a long wait. The mother and father of all equity bubbles is Japan in 1989. And they're still waiting. So that's 22, 23 years, and they're still not back to the high. And what happens in real life is people don't hang in and wait for the 40-year return, in the case of Japan. They change their strategy and abandon ship as the market goes down, more often than not. So these are very dangerous events, and you don't want to ride through them if you can avoid them, and they're not that common. So when you are unfortunate enough to have one, my advice is to do some sidestepping of some of the pain. About 25 years ago, we felt in order to talk about bubbles, we should probably define them statistically. And so we did just that, and we picked a standard statistical term of a 2 sigma. A 2 sigma event is the kind that should occur every 44 years in a perfectly random world. And with human beings who are capable of being a little inefficient, they occur every 35 years in the equity markets. Close enough, I would say, for government work. And we noticed that all of them in the developed world, in modern times, in equity markets, went back to the trend. And the trend is easy to measure. The 2 sigma is pretty straightforward statistics. And the fact that all of them went back, without exception, we find a very compelling idea. The complexity comes from the fact that some of these 2 sigma events continue to go up. And 3 of them in the US have gone up to 3 sigma, which is the kind that you would expect every 100 years. But as I like to say, humans do seriously crazy pretty well. So they are much further away from random than 2 sigma. And 2 out of 3, certainly more than half of 2 sigma go on to 3 sigma in recent times. And the 3 sigma events we have are 1929, 2000, and today in the equity market, and Japan as a major market overseas in 1989. And it doesn't change the outcome. You go back to trend. But since by definition you've gone further up, it takes longer and more pain to come down. And the quicker the bubbles end, the better off everybody is. And we mentioned that this one was a 2 sigma back in July of 2020, or August, about 3,500. The trend line is about 2,500, 2 sigma is about 3,500, and 3 sigma, 45, 4,600. We got to 48 in December. And if you're going to have a bubble, it's better to break from 35 to 25 than it is to break from 48 to 25. And therefore, the real McCoy super bubbles are extremely painful in terms of a reduction of perceived wealth. And there is a wealth effect. When they muck down your portfolio or your house, you spend a little less the following year or 2. I have to admit the housing market doesn't seem to have the kind of psychological accompaniment of a crazy bubble like the stock market does. And it didn't worry me much back in July of 2020, but then it decided to go into warp drive, and we've just had the biggest move in a 12-month period in the history of US real estate, about 20% in the last 12 months, and quite a bit in the previous 5 or 6 months. So since the US equity market reached 2 sigma, bubble territory, the housing market in the US has shot upwards with great determination, and it actually sells at a higher multiple of family income than the housing bubble of 2006, 2007, because of that 20%. 20% is a lot more in housing than 20% is in the stock market. That is just an amazing move. And it has certainly made the US housing market extremely expensive, the highest price it has ever been as a multiple of your ability to buy it, family income. And history's been pretty straightforward. Whatever you do, don't have gloriously overpriced housing markets at the same time as you have a stock market bubble. Japan tried it, the biggest land and real estate bubble in history anywhere, arguably the greatest bubble of any kind anywhere. And simultaneously, they had 65 times earnings. It was said at the time in the Japanese stock market. That was the ultimate definition of potential pain, as you had to mark them both down, and they did. And as I said, stock market isn't back to 89, but the land market isn't back to 89 either. So you had double jeopardy, a lost decade, and you could say that those two bubbles from way back in 89 are still casting a shadow on the Japanese economy. Actually, exactly my view that the housing market is not as reliably mean reverting as the stock markets have been. And the reason why not is because of zoning and all manner of inefficiencies that unfortunately surround the housing market. If you won't let people build houses, then you get a chronic housing shortage. And most of the great markets in the world today have chronic housing shortages. They haven't been building enough in the UK for decades, or Australia, New Zealand, and many European markets. They're simply underbuilding, generating a shortage, and people simply have to pay more and more of their limited resources to buy a house. We didn't fall in that category until recently. And you could divide the housing bubble into two groups. Those where you had strict zoning and restraints on building. And when the housing bust occurred, they went down a bit, but they regrouped and went to new highs. And then you had the three markets where they were really cranking out new housing. In Ireland, they were covering the whole island with new houses. In Spain, everybody had to have two houses. And in the US, they were cranking out an extra 1.5 million houses a year over normal. And in those three markets, they caught up, they glutted the market, and the great housing bubbles collapsed and went all the way back to trend in the case of all three of those markets, and below trend in all three of those markets. And this time, we have insufficient housing. So you can't depend on the speed and extent of the decline. The problem is, if the US equity market goes down, if it casts a shadow on confidence, if it weakens the economy a bit, if there are other economic problems, then I expect the US housing market to weaken. The way I describe this is the potential for write-downs in asset prices, in perceived value of your assets. If you are a record distance above trendline price in the US housing market, even though there's no immediate reason why the house market should collapse, you will expect at some indefinite period in the time, when people are pessimistic, the potential is there for substantially lower house prices. And one thing you should bear in mind is that housing is a complete creature of the interest rate through the mortgages. Mortgages, there's nothing like that in the stock market. They're huge leverage, they're fixed term, they're completely institutionalized, they're completely socially acceptable, and they give you a level of leverage that you could only dream about in the stock market on very favorable terms in the case of the US. And if they lower your mortgage, why would you not pay more for your house? Someone says to me today, well, what should I do? I need to buy a house. My attitude is, look, they're badly overpriced. Here's the data. They're higher priced compared to your income than they have ever been. But the mortgage is the lowest price it's ever been. The mortgage, if anything, is more underpriced than your house is overpriced. If you can guarantee to keep it for the life of the mortgage, 30 years, and you are prepared to rent it out if you have to, it's highly likely that you'll do okay. You may not do brilliantly, but you should do okay, and you may do very well. So housing is a complete creature of interest rates. Makes it easier to understand also why interest rates drive asset prices than it is in the stock market, where it's a little more complicated. I've tended to say we have 3.5 bubbles. Commodities are a little bit different. I don't fear them because we're going to lose income or assets when the price of commodities go down. Ordinary people don't own big positions in copper and oil in the futures market. What I worry about is the income effect. If the price of oil goes to 120, which it may well, and the price of metals keep on going up, and the price of food keeps on going up, it simply squeezes your income. There is less left over to do everything else. And in that sense, you're poorer for dealing with the rest of the world. If that coincides with the wealth effect from a stock market imploding, you have a double whammy, which you had in the housing bust. Housing came down, and in a sense, it took the stock market along for the ride. The S&P went down 50%. And there was a very handsome negative income effect. At the same time, your house was going down, and your confidence level was falling. That double whammy, which they had in Japan for 20 years, really, we also had in the US. And it was much more painful and guaranteed a much tougher economic environment than we had had for quite a few decades. So you don't want to do that. And you're playing with fire if you combine the lowest interest rates and the highest bond prices in history with the highest stock market in history and the highest multiple of family income in housing. I'm not saying that they will all go together. There are reasons, as you suggest, that the housing market may unravel more slowly. It will be more a slow, steady function of interest rates. And nevertheless, we're playing with fire by having all of those things overpriced at the same time. We're running the risk that we will be squeezed by high energy and commodity prices as we're squeezed from the loss of perceived value in our housing and stock market.